Good afternoon, ladies and gentlemen. Welcome back to our live stream from the video studio of CFA Association Russia. We keep inviting members and eventual non-members to our studio, those who can contribute their expertise to the audience, to members and the financial community in Russia and CIS. As usually, we are broadcasting this to the general public live, but the recording will be available only to members on the website of CFA Association Russia. And today we continue our series of meetings of webcasts from Switzerland. We did already a few ones since the spring of this year, and we welcome back our prominent guest, the experienced asset manager, Andreas Bickel, CIO of Blackfort Capital, who has experience in asset management for over 25 years. He used to be portfolio head of portfolio management at Goldman Sachs, head of portfolio management at Rothschild Bank, and now CIO at Blackfort Capital, and our regular macroeconomist at CFA Association Russia. So I remember the early webcasts of the year where when Andreas took the risk of being bullish, and that probably turned out to be a good strategy. So welcome back, Andreas, and how did your outlook change since then?
Good afternoon from Zurich, and thanks for the welcoming remarks. Well, I would say in a nutshell, from being cautious over the summer, a bit too early to bullish again. But let's go step by step, and let me share with you my screen.
Let me remind our audience that we are receiving your questions in the chats, both on our website and on Facebook. So we will be transmitting your questions to Andreas.
So let me show you the agenda. As the title implies, there might be a new reality in front of us after or at the moment during COVID-19. So on one hand, I will cover what the Fed has changed and what is my taking from it. I will give you an explanation why we haven't seen inflation over the last 12 years, although global stimulus from the monetary side was tremendous. I do think we need to see more fiscal stimulus, and I will give you an update on that topic too. The main thing probably is market outlook, but before that, I give you my take on macro as usual, deliberately not as an economist, but rather as an asset allocator portfolio manager. Last but not least, I try to give you some supporting information why my outlook is rather constructive. Basically, it is based on fund flows, on liquidities, and as usual, it will end with possible areas to invest. The Fed, as you know, has last week announced that they have now, instead of a fixed 2% inflation target, which they try not to overshoot, and full employment, they have now a flexible form of average inflation targeting. That means they deliberately stated we want to see in the future inflation above 2%. And if that is going to happen, and the risk of the pandemic is fading, as we all expect, nobody knows when exactly, but we all expect that this will happen, they will stay accommodative for a longer period of time. That means they want to produce by all means inflation. Or in a nutshell, key message is lower for longer, which we mean the interest rate. This is now basically one of the key things the Fed wants to achieve. However, they forgot to tell us with which kind of tools. And I reckon that they don't really know which kind of tools, apart from the stressing that fiscal stimulus is needed. One thing of this policy change is to nudge people and investors into stocks, which is obviously a deliberate outcome. As you will see, the Fed official rate, that's the chart on the top, which stands at 0.1%, and the 10-year US Treasury yields, which stood at 0.65%. As we speak, we are slightly above 0.7%. So at extreme low levels, you see the history from 1995 in the Fed rate, and a bit shorter, roughly 10 years shorter in the Treasury yields. But what's the key message for me is another thing. The CPI figure, which is low at 1.2%, and the PCE deflator, this is the deflator for the real GDP in the US, stands at 1%. Both are, although low, higher than the yield you get up to 10 years in risky assets, riskless assets. So basically you get risk and no return. Actually, you get real negative return. And for those of you who were participating in my previous speech, you know this is one key element of what I call financial repression. The point here is, why was there no inflation over the last 12 years? And I found a very interesting explanation over the summer, reading a book from a strategist of Japan. He claims, and disclaimer for all those of you who will have to write CFA exams, I would definitely not mention this unless you are really, really sure that the guys who will correct that are aware of this other half of macro, as it is called. You get the textbook, what we all know, that is a equilibrium or disequilibrium of borrowers and lenders with the purpose that demand and supply find interest, and this interest has a price information, and it steers somehow the economy. However, since 2008 in our area, since 1990 in Japan, there were other examples in the history, but these are the two prominent ones, we have a mismatch. And this mismatch, according to Richard C. Coe, is we are in a balance sheet recession. Although all the stimulus is put to accelerate growth on one hand, and especially to nudge people to invest, not just to buy stocks, to really invest, it doesn't work. And there is an explanation for this, which is controversial, but I find it very inspiring, and it fits my narrative of the future, which is also something I learned over the summer. The Cape PE inventor, Professor Schiller, wrote a book about narrative economics. So if you put something in a narrative and it gets viral, like a pandemic, by the way, it might be self-fulfilling. In this case, this never went viral, but I think it explains what has happened and continues to happen. So before I show you what happened, what I'm talking about, I'm talking of a balance sheet recession. This is a very, very special type of recession. Basically, it means that the private sector, private individuals and corporations, they use the additional cash through monetary stimulus not to invest. It is not stimulating. It is not creating inflation. By the contrary, they use it to downpay their debts, or as Richard Coe puts it, it is a debt inflation. A similar view, Irving Fisher from the US, a very famous economist, is agreeing partially, but in the details they are disagreeing. As an asset allocator, excuse me that I stay here on the surface, but if you believe that this is true, it shouldn't come as a surprise that there was no inflation. In 2012, the Fed of St. Louis did a study, and they basically have two time series, which they put in this graph: business investment and private saving. And the conclusion in 2012 was, well, guys, we have a surplus of roughly $800 billion. People at that time, there was QE, there was a lot of stimulus, but there was no inflation and there was modest to sluggish growth. That is already a huge gap. However, as there is a source underneath, and you see also the source of the Fed, regional Fed homepage, I went to this homepage and I tried to find a chart, which I was not able, but I have the name of the 2 time series, and then I did an update on that. And although I believe in balance sheet recession, and I keep repeating my narrative of financial repression, which somehow interferes or overlaps with modern monetary theory, the 3 things are not the same, but they are basically covering the same theme and have some same conclusions, but other measurements. But basically, when you do that, you get this shocking picture. These are the same data. So if you put 2012, you see this roughly 800 billion, but now it's more than 6-fold higher. And it has, during this pandemic crisis, significantly increased, and the investment have significantly dropped on the top. So I go back, you see here the original study, the savings blue on the top, the business investment underneath, and we had a huge gap. And now, with the same figures, you see, since roughly 12 months, this gap has exploded, not just widened. And I have said in my previous talks, I believe that the remedy, the medicine of monetary stimulus is not working. And it is not working. However, I also said, I believe, without knowing what I know now, that probably the only way we get out of this is through fiscal stimulus. And if you look at this, the conclusion of Mr. Koh and even of Mr. Irving Fisher is that in the first case, in the Japanese case, in all cases, fiscal stimulus will overcome this situation. And in case of Irving Fisher, he made some twists and says it depends also on demand, supply, etc., etc. But bottom line, you need fiscal stimulus to get A, more of growth, and on B, that you create midterm investments and inflation. That's the key point. Having said that, obviously, I should give you an update on fiscal stimulus. The sad news is what was shown here in June or drawn in June is still true today. So in the US, the 5th package is still pending in the parliament. The parliament is at the moment trying to find that at the end of the month, there is no stop, that the budget continues, but they are not discussing or deciding on additional fiscal stimulus for roughly 4 weeks. The old stimulus, the 4th package, has ended. So if you are unemployed, as an example, you don't get anymore your $600 a week, you get at the moment $0. And in the Eurozone, in principle, it was agreed that there is the recovery fund plus the traditional higher budget. However, the European Parliament hasn't talked about the details, hasn't agreed it, and they want a lot of changes. So it's in the air when and if and how it will be decided. Nevertheless, for instance, France has decided to put 100 billion of fiscal stimulus at work over the next 24 months. Half of it should come from this rescue fund. So it is really key for the future and also for the macro outlook that we will see this fiscal stimulus. Today, just before this meeting started, the ECB has announced, and I only saw the headlines, but has announced that there will be at the moment no additional bond purchasing programs, and they believe that it has worked well. It's questionable, but what it definitely did, it has had a positive impact on the euro dollar, so the euro strengthened significantly, which is actually, and we come back to that in a minute, which is actually a rather mixed to negative impact or view for European equities. In the beginning, it was said that I was quite positive after the crash in spring. Here you see, in hindsight, obviously very simple, but you see here one reason why. These are the Citigroup Economic Surprise Indices, and you see they have a trough after the COVID and global lockdown announcement. And in the meantime, up till the beginning of probably July, we have seen always surprises. And since then, this news indicator is either rolling over. I prefer its mean reverting and might go back to the old normal and oscillates around the zero level. This data is unfortunately roughly 5 days old, so the sell-off is not included. It is probably fair to assume when I get the next update, we will see levels closer to the average than where we were, which would then be kind of positive for the midterm outlook from this side. Maybe just to explain, if you are an asset allocator, I love to see troughs and peaks because both give me a hint that there will be negative surprises on the economic front, and most of the time, but not always, this has a strong correlation either with bond yields and prices or with equity markets. And this time, with a delay, we have seen an overdue correction in the stock market. So if you will, and if you would have seen this data before, you could have been cautious during the summer. However, it would have happened the same to you as it happened to me. I turned cautious in July when the distance of the S&P price to its 200-day moving average was overpassing 25%. However, it only peaked end of August at 35%. So you would have missed the last bit of the rally. The key question obviously is how will it continue? Today I've read that our Swiss economic forecasts have officially been changed from very negative to negative. I expect similar things to happen from the IMF and from the World Bank. Personally, I prefer to look at indicators. In the past, which means in June, I told you, these indicators are probably extremely distorted because if you ask somebody in a lockdown how you see the future and you have three options, better, worse, or equal, most likely the outcome will not be compelling. In normal times, however, this gives you a good hint of where the global economy and with a certain twist also markets might move. And the news for August is rather positive for most areas. So the global PMI is almost at 52, that means growth. The very strong contributor are the US and China, which are more than 50% of global GDP. Another good place to be forward-looking, not backward-looking, is probably Brazil with more than 60. I was astonished by that. I personally like to look at Switzerland and South Korea for the simple reason both areas have industrial production and export. In both cases, we are in the growth area. And in general, in Europe, the figures are okay-ish. However, they got worse over the summer, with the exception of Germany. But even there, this is just the industrial part. The service sector also got weaker. But Europe is rather slowing down, while most of the rest of the world looks very good, or at least much better than the expectations. This, however, doesn't mean that we will see growth like before the crisis. It's just the direction which is positive. But if you invest money, the direction is key, and not if the US grows at 2% or 2.5%, or maybe just at 1.9%. This is not relevant for investing. And here you see it in a bit more in details. China, the PMI rose to the highest level since 9 years. Very encouraging is the new orders sub-index, which is at almost 55. That basically means that we have a strong acceleration in China. That shouldn't come really as a surprise. We also see that the air traffic for freight has increased, but with a nuance. The green line shows you in mainland China, inland consumption by the end of the day is almost at levels like before. In some areas of China, it is at 60 to 80%, but generally the message from this slide is within China, it is strong. With China, it got better, but we are still far below than before the crisis. China import and export with the US, you know, there is the trade deal. The second part or phase of the trade deal probably will not be implemented before the election and might be never implemented. What we can see here are two things. On the right-hand side, you see the green line that shows you export to the US. They have recovered. They are even higher than in March this year. And underneath, you see imports from the US, and you know China has signed a contract basically agreeing to import more goods, in particular agriculture goods, from the United States. This didn't really happen. And you see that on the left-hand side, for instance, the bar shows you the trade balance. It got a bigger surplus, even bigger than in spring. What is not showing on these charts, but what was in the same research, we see that the inter-China exchange of goods with Taiwan is substantially increasing, although the political pressure on both sides are rather increasing than de-escalating. So within the Asian area, you see definitely a strong uptick. And for me, surprising is that Taiwan and China have a stronger relation than before the various news we have seen over the last 12 months regarding integration, occupation, being one country, one system, because Taiwan, so far as you know, is independent of China. The same for the US. You see here the manufacturing in orange and a bit reddish, the service sector. Both are above 55. That means strong growth. The service sector has slightly come down. Basically, what we can conclude from here is that the domestic growth in the US and obviously in China, as we have seen before, is definitely increasing and at a very good level, disregarding the thousands of cases of COVID and deaths in the US. But the export part is definitely mixed. You can see this here for Germany. Underneath in the black line shows you the seasonal adjusted export year-over-year changes. There is a V-shaped recovery. However, we are only roughly at 2/3 of the levels before the crisis. The IFO manufacturing expectation index shows you or has indicated to you some months ago that this will happen. However, the magnitude is much lower. And the same you can see in the trade balance above. Yes, they still have a good surplus and we are getting closer to levels before, but not all of it comes from export. And in particular, the car industry is suffering, as we all know. Also here, hints of a de-globalization. South Korea, it used to be the country with the leading indicators to foresee growth and with a certain delay, probably markets or movements. The good news is year-over-year change of export was beating expectation at minus, let's say 10% to round it up, but still -10. But the news which didn't make it to the headline, the imports were collapsing more than 16%, expected was 15%. Again, a hint that the The globalization is unfolding. This is one of the goals of Mr. Trump, and one of the goals of China is that the inland consumption gets stronger and that they can self-sustain their economy with their own consumption. The good news here as well, you see that the survey of GDP year over year was minus 2.9, and what happened? It happened like I reckoned in Q2. It was obviously negative, by no means. That was definitely to be expected, but it was better than expected. And this happened with almost all economic figures, and it happened as well with earnings, which we will see in a second. So therefore, the gloomy outlook you have seen from economists, World Bank, IMF, etc., regional ones, didn't really manifestate. Partially because of the fiscal stimulus and obviously as well of the monetary stimulus across the globe. However, the new normal. On the left-hand side, you see 3 areas of the world of people who commute or stay at home or work in the office. And the key message is roughly we are at 85% of the level before the corona crisis. What this data cannot show is on the right-hand side, flights or industry which are dependent on, for instance, tourism, also restaurants. They are not at 80 or even 90%. They are rather at 50 and below. Or if you look at guys who do concerts, we still have close to 0 concerts. We have no fairs. Therefore, the economy is moving towards digitalization, which obviously is not really a surprise. I'm sitting in Zurich, you sit in the CIS country. Our host sits in Moscow, and we communicate almost as we are in one room. This is also the new normal. I can talk of our industry. Although I was most of the time working from home, I had more to do than before. So the future will be compared to before, the level on average will be lower, but some areas will profit and some will have a long way to go. The airplane industry is expecting to be back on levels pre-crisis only in 3 years from now, in a good case scenario. This rather mixed outlook, I would like to conclude with a stream I have attended yesterday. Jim O'Neill, former head of Goldman Sachs Asset Management Research, Head, the inventor of the Acron bricks, and now the chairman of the Chatham House in the UK, has shared with us his outlook. There are 2 key messages. One, for the global economy, the actual decade looks rather strong with 3.5%. However, not surprisingly, the contributor to that growth are China and India to the largest extent. Some comes obviously from the other BRIC countries, and a lot comes from Asia. But the key message is different to the 80s and 90s. We will see rather strong growth, but not in Europe, and to a lesser extent in the US and in the UK. This can also be a conclusion for investing. I strongly believe that Asia is an area where you should consider in various ways to deploy money. And in a short run, maybe Brazil, although this is a 10-year view, but for this we'll come back also in a minute. So the macro outlook, I would say, is probably Q3 figures will be positive. The recession might be over, or if not, it might be over in Q4. However, at the moment, we have some signs of a slowdown and that we won't reach levels before the crisis this year or even in H1 next year. Nevertheless, the outlook is still, at least from my humble view, positiver than the official IMF and World Bank forecast. I remember I have shown this chart also in these previous presentations. At that time in spring, the question was, will we break out or not? I have shown there 3 scenarios, and I believed that we probably will break out. And I gave various reasons. Of course, little did I know that this happened. So we did not just break out, we have reached new all-time highs. The old one was in February, until the end of August. And now, obviously, the key question is, what comes next? Where are we in? Or is this the beginning of a crash, a correction, consolidation? The short answer is nobody can know. It's probably not the one you expect. The more pronounced one is, if I look at this chart, there was no panic in selling. This you see underneath in volume. The RSI, which is a kind of indicator of stress, overbought or oversold, is somewhere neutral. And above, you see that the so far correction went to the 50-day average, but it didn't go to the 100 or the 200-day average. So if I have to guess, and that's what it is, I would say we have seen the first leg of a correction, and there is a risk of a further downside. I would buy the dip, but today, before the market opened, the futures have turned positive because of the ECB talking and of the stronger euro against the dollar. But I would definitely wait till the dust settles or enter in waves. Why is probably the question. But let me start what has happened. We have seen new all-time highs driven by 6 to 10 stocks. It depends how you calculate them. Here is the FANG. Nobody can pronounce that, so I call it FANG Plus. And in the FANG Plus, I would include Tesla and Nvidia. But this handful of stocks was responsible for the whole rally. All the other stocks in the S&P 500 basically were flattish or even correcting over the summer. We made new highs in the indices, in both in the Nasdaq and in the S&P, while volatility was going up. That is extremely unusual that you have rising market while volatility rises. Therefore, it was more than obvious that we will see a correction. However, if I look at the price movement of this fund complex, excuse me, and I compare it to the past rallies or bubbles, if you will, we were definitely in a bubble territorium, and we have corrected roughly 15% of this overreaction. Therefore, it is another hint that the correction is probably not finished yet. Why I'm saying this, that by the dips? Well, globally, we see, based on the MSCI World, the earnings sentiment is positive. And actually, it is so positive like a long time ago. So this measures basically upgrade and downgrades and puts it into relation to each other. And we see at the moment that there is definitely an overhang of upgrades. We also see that in May, there was the opposite. And in May and in June, I was reckoning that we will see that the real earnings in Q2 reported in August will be bad, but they will beat the estimate of the bottom-up analyst. And that happened, and we were at an astonishing 84% beats. The missed was a very, very low portion, and together with the Met, we are roughly at 90% of the whole S&P 500, which either met or surprised positively. However, the earnings per share for the index dropped dramatically. But as you know, while this was reported, the index kept moving up. And this is probably the game we're going to see in Q3. So although you see here a globally positive earnings sentiment, I took the chart of the US, looks exactly the same, even more pronounced. I would reckon that in Q3, which will be reported in 1 month, 1.5 months from now, we will see a similar picture, but not at this high level. But that is a positive, obviously, for market outlook from the stock angle. I found the weekly comment of BlackRock inspiring and shocking at the same time. You see here the spread from investment grade and high yield in dollars. What they basically did is they have changed their allocation from investment grade to high yield. Fair point, but if I look at the spread compression we see in US high yields here, or if I look at it globally, it is a bit late. Although we agree with it, we would argue that until the end of the year, hopefully we see the coupon and some mild compression of the spread and no more widening. What is also remarkable, this chart was updated this morning, that, for instance, the orange line, which is the US high yield spread, the recent sell-off is almost not visible. So the spread widening during the last 3 negative trading session is almost neglectable from corporate bond angle. So therefore, we agree with the view of BlackRock that corporate bonds, in particular in dollar-dominated, are a very good place to be. If I have to rank them regionally, I prefer Chinese, in particular property bonds. Moody's has recently made a sector update and confirmed a stable outlook. And then I would go for US corporates. Nevertheless, why I think it's not over yet, if I look at this, at the FANG index, so 10 stocks, you see them on the right-hand side, and I see the same chart like before we have seen in the S&P. So you see the RSI is neutral. The volume has picked up, but we are just down to the 50-day average, and we are significantly up for the year. Before the beginning of today, in the morning, the future was negative. Now the news half an hour ago was futures have turned positive on tech buying. So what has been sold 2 days ago is now being bought back. And I hope that this correction might last, but I cannot rule out that we just continue to go up from here into higher bubble territory. As you probably remember, I was always cautious on Europe. I would even say I'm bearish, but I try to be here neutral because this is against all consensus. But look at the right-hand chart. Europe, measured by the Euro Stoxx 50, I know this index is not the broadest, but it shows the 50 largest Euro Stoxx has done nothing over the summer. Nothing at all. One reason is the stronger euro, and you see it on the left-hand side, this recovery rally compared to the one in 2013 and after 2009 was extremely muted. And honestly, the growth outlook for Europe is at best muted. Finally, the ECB is doing something. However, if I see what France is going to do, they are going to put 100 billion, most of it in the motor industry, so in a technology which is going out of business over the next decades. Therefore, I'm staying still cautious on Europe. Today, the dollar is again weaker in terms of Europe. Now it comes the point which is very important. If you were an American, or if you were really thinking and calculating your performance in dollar, and you were invested over the summer, you still had made a lot of money. Why? Because of the dollar depreciation and obviously the stronger euro. This is one key element. It is really important in which currency you think and pay your bills by the end of the day. The same holds true if you would think in pound. Pound got weak. So basically, if you were a UK guy and you pay your bills in pounds, you could have invested almost in anything in the world. You would have made money, not because you were a genius, just because the pound is weak. And over the coming month, it looks like after recent events with Boris Johnson that the hard Brexit gets more likely. You know that I was positive on gold. I was astonished that we have reached almost 2080 for an ounce in the summer. Since then, we are consolidating and correcting. I would keep gold on the radar. There are several supporting factors, starting with the new Fed policy, letting inflation overshoot. The whole yield curve up to 10-year Treasury is in real terms negative. The shadow rate, which I've mentioned the last time, is negative. There is still the risk of a yield curve control, an explicit one. Implicitly, the Fed is already controlling by their buying program the yield curve. These are all factors which are rather positive for gold. I'm no expert in oil, but as almost every time the question of oil came, I would be extremely careful for various reasons. One is the demand for oil is still 10% of below the crisis level. We have seen Saudi Arabia cutting the price for its oil, and we saw a dramatic sell-off in one day of the oil price. Therefore, I would be careful. There is a lot of ESG discussion investment, so there is pressure from the investors. There is pressure from the kids, or if I may call them this way, the future of the planet is at stake, and the new energy, new technology is pressuring. So there's also a structural shift away from oil. And last but not least, if you were to invest in oil or before the summer, you would have had a roll loss due to contango situation in the future market. And thus you have to invest in the future market. Before you do that and you buy an ETN, so an exchange traded note on oil, you really should understand what is such a product doing. Are they investing in futures? The answer is almost always yes. And then in which contracts? And as the curve is contango, in some areas, you lose even if oil would go up. So therefore, my humble assessment for oil is it is good for the industry that the prices are down, but as an investment, I personally would not invest into it. As you know, I said it now several times, I believe that the US market, and obviously with it the rest of the world, will go up. One reason is over the summer in August, we have seen more than 12% outflow of US equity, although we have reached various new record levels. The money went on one hand into bonds and on the other hand into international equity, from the American side mainly into European ones. There was no selling panic in the US market, and one reason is because most asset allocators have already shifted away and they had no need to further decrease equity risk. There is, on the other hand, that's another reason, a huge amount of cash laying around, as you can see here, money market products. Goldman Sachs claims the little erosion over the summer is basically put by mostly retail investor into fund stocks. And actually, the selling of the rally was rather driven by options, by gamma, for those who are aware of Greeks. So there was a lot of selling pressure 2 days ago, and yesterday, the same reason, option-driven, the market went up. There was really no news. But the good news was when we had the sell-off on the 18th of September, when I looked at the market at 2-3 o'clock our time, we saw roughly -2 to 3%. We closed -4 to 5, depending on the market segment. But the implied vola during this sell-off increased. That definitely is a hint that there was no panic. Or to put it in a very simple example, if you were to buy a put at -2 and you wanted to sell it before the closing, actually your put would have been, if you were lucky, flattish. And I know painfully an example where it was even negative. So although the market went down, although you would have been on the right side of the market, you would have lost money due to the implied volatility, which decreased during the sell-off. This is a very, very strong signal for me. You can obviously disagree, but I believe this market has to rally further. If you see underneath the line, which is going slightly down in light blue equities, if I'm positive, I can say it is stable, but you saw the figures, we have even seen outflows during the summer. So equities are a hated asset class. I would definitely not invest in government bonds. Look at the orange curve. And we have seen the US Treasury is now in real terms negative up to 10 years. European government bonds, be it in Germany, be it in Switzerland, be it in most other countries, are for a start having negative nominal yields before inflation. This chart is extremely impressive. I think the conclusion of the person who did it is a bit too strong. Nevertheless, you see that the money supply or the excess liquidity he derived from it, if he compares it to GDP, nominal GDP, is huge. And he claims that the actual PE for the United States, which is roughly 22 after the sell-off, should, if you believe in this correlation, and there I would make a question mark, but nevertheless, should be at least double. Well, if it would be double, I don't know where exactly the index would trade, but one thing is for sure, at the current level, although I believe we are not cheap at all, would look like a joke. So these are all hints that this rally is not over yet. With this, I come to the obvious conclusion. For those of you who follow regularly my speech will see that some things have not dramatically changed. However, the wording is slightly different. I mean, it starts with a pullback, which was overdue. I still think it is not over yet, although we were slightly up today and strongly up yesterday. So I would use this dip if it continues definitely, and if not, then the pain trade to build up over the next weeks some equities, preferably Asian, US. Both I prefer over Europe. For those who are risk takers, Brazil has a strong PMI. We have seen that at the beginning. Brazil has a weak currency. The Brazilian market is cheap. The outlook of the economy can actually almost only get better. And then we all know the risk. I mean, the government, etc., they don't have it under control with the COVID situation. But if you are a risk taker, at least consider that area. This is more a trading idea than a fundamental driven idea. We still believe in corporate bonds. Do your homework. If you buy non-investment grade bonds, there in that segment, there are companies with stronger balance sheet and strong cash flows, and there are obviously other ones. That's why the rating is non-investment grade. We believe that there you can make good value, and you are protected by the Fed and other central banks. The zombie companies in the Russell 2000 is roughly at 20%. Over the coming 12 to 24 months, probably most of them will survive, because they can even, with a twist, get a credit from the Fed, or if they don't get money from the markets through bond issuing or through banks. Emerging market corporates, most areas look attractive. The US dollar probably weakens further, in particular before the election. I haven't listed the election. The election is a kind of neutral, because there were some analysis done. it doesn't really matter if A or B or wins, markets on average go up. I would be a bit careful in this situation because Mr. Biden's idea would obviously favor clean energy, and this favors some other part of the markets. It is interesting to see that during the summer, since the news of from the COVID area got less attention and got better, and on the other hand, the markets have reached new highs. The distance between Trump and Biden is shrinking, so they are almost even. The latest news, the latest books about Trump are shocking, but so far we don't see that the confirmation ratio or his distance to Biden is widening, it's rather shrinking. Whatever you think politically of both of them, but for the markets, probably midterm Trump would be better. In this uncertain time, with this infinity low rates in the US and across the globe, we believe that real assets, in particular gold, should be part of your strategy. There are others which I cannot recommend, but you see that thing you can collect, like old-timers, art in general, some special watches, they are all increasing in value. However, there are also market segments where you can fall on your nose, and it all depends on demand and supply, and it's not so easy to sell when you really need cash your collection. Warnings are very similar to before. You cannot make a value case. Even after these little correction, assets are expensive. Bonds are unbelievably expensive. Spreads in the corporate area are at extreme levels, extreme low levels. They can get lower, I know that, and we invest there because somewhere we have to invest. But it's definitely not a value situation. If Mr. Cole were right, we have a balance sheet recession. Therefore, we see more debt repayment, and we definitely have to see more fiscal stimulus to get out of this. At the moment, and this was unfortunately already written 2 months ago, the fifth package is still pending in the parliament, and it probably will stay pending till October. And in October, it's questionable because it's before the election. Let's see. The announced fiscal stimulus in Europe is extremely positive if it's implemented this way, at least short term for markets, liquidity driven. Midterm, it really depends how you execute that and where you invest. If you do it like France has announced and you help your car industry, and Germany does the same. On one hand, yes, I do understand, and if they would invest into new technology, fair point, but the pressure and the direction into be it hydrogen or electrical cars is definitely too low. And just to keep structures alive, jobs artificial alive, is short term for sure okay-ish to positive for markets, but midterm Europe will not catch up with the US and in particular fall behind the Asian economy. Last but not least, I still believe that we probably gonna see in the US some inflation. This on top of it obviously would help the target of the Fed. It would fit my narrative on financial repression, and it would also help to repair the balance sheet, because if the real value of your debts is shrinking due to higher inflation, you also solve or repair your balance sheet over time. Last but not least, I know how simple this statement is, but don't fight against the Fed and against the US economy. But don't forget that there is another huge area, which is Asia, where opportunities lay ahead of us. With that, I have finished my part. Thank you for listening.
Thank you. Thank you very much, Andreas. We have some time remaining for the questions. So maybe if you give rather short answers to the questions that we have received, as usually we have questions basically about three areas, about countries, the economies, about instruments, about industries, and some practical questions about portfolio management. So, well, Sergey on our website is asking probably if you could elaborate a bit on the inflation outlook, given that the fiscal stimulus have been so huge in various countries. First of all, what is the longer term outlook on inflation? And second, is there a correlation between the scale of fiscal stimulus by particular countries and the depth of the GDP fall? So was it a good strategy to do huge fiscal stimulus?
Okay, I mean, is there a correlation between fiscal stimulus and large debt? This is a tricky one. For instance, China had a lot of fiscal stimulus and they have a lot of debts. The same holds true for Japan. In the middle is somewhere the US. And in Europe, it depends on the country. But I would argue that fiscal stimulus is definitely needed, that the economy keeps rolling. Inflation, as you know, at the moment we have disinflation. I strongly believe that there won't be across the globe inflation over the next 12 to 18 months. But in the US, there are some structural changes, some administrative prices which make experts believe that by the end of next year we will have a core CPI above 2%, which would be what the Fed wants to achieve. If that's going to happen, is very controversial. It would, however, solve certain problems of the debt burden in real term.
Right. Well, about the markets. Well, Yuri is asking where you can find potential except Asia for the nearest 10 to 20 years. Maybe a bit larger. What could you say about particular emerging markets? Which ones suffered least in 2020? And also, among other, how did Russia perform?
Well, which suffered least is China, Asias, they are even up. The ones which suffered a lot and probably the most is Brazil for a start, and Indian equities. I mean, over 20 years, if I'm blunt, I would say you can buy any market, they will go up. However, the US market, for a start, has a Schiller P of roughly 30. And that means over the next coming years, 10 years, sorry, not coming years, 10 years, you probably can expect somewhere 4 to 5%. In real terms, while normally you would rather expect 7. And if you look at Schiller PE, and this is any guide for long term, this is not a timing indicator, then you could consider Russia is extremely cheap, Brazil is cheap, India is cheap, China is not so cheap, Europe is expensive, in particular Switzerland is expensive. I mean, if you are a risk taker, India and Brazil, if you want to play it safer, obviously you can go for Chinese A-share. They are very volatile, but most likely they will be higher in 5 years, 10 years, 20 years from now. Although I'm, from an economical angle, not really constructive for Europe, but if you have 1 to 2%, markets go as well up. And the US short term is probably still, together with Asia, leading the pack. And I would bet that the fund complex will go into a bubble. The key question, which obviously nobody can answer, is will that bubble burst now? Probably not, but I don't know. Will it burst in 2 to 3 years? Possible. Will it burst over the 10 years? For sure, but when? Nobody really knows.
Okay, coming to the industry, down to the industries. Yuri is asking which industries are the most resilient ones in this new after COVID era, but maybe putting it a bit more general. Well, we should talk maybe a bit separately about IT and about the rest of the economy. The stocks, the IT stocks, which were way up during the quarantine, there was a correction. Do you expect other waves of correction there? And also talking about other industries, how did they perform?
I mean, on one hand, this digitalization process is unstoppable, and all companies which are somehow profiting from this move, these are the obvious FANG stocks, and there are some which we might not even know how they are called nowadays, is an area. In general, I would say artificial intelligence. There is, for instance, BlackRock has launched an interesting product covering next generation technology. I have checked the top 10 holding and I knew 2 names, obviously from the FANG complex. All the others were unknown to me. A bet is hydrogen. There are 4 leaders, but there are much more companies. Most of them are loss-making, so it reminds me the .com of the 90s. Some of them, but which one we don't know, will survive and will be the winners. I mean, for those of you who are long in the market, Apple was once trading at $1-2, and now it's the most valued company in the world. And it's a huge cash cow, and some value guys even think it's a value stock, even after the movement. Everything which is healthcare and digitalization, there is even digital health, will probably do well. Then Asian health is developing. I mean, the middle class wants not just to consume, they want also to consume a better health products, hospitalization, treatments, and also they will have certain problem regarding diseases you get when the country is getting wealthy, so diabetes, to mention an example. Probably everything which has to do with medtech will profit. And region-wise, most likely you will see the Asian complex outperforming. I'm a bit cautious with frontier markets, or like Indonesia as an example. I personally like Vietnam, although Vietnam is similar to China in terms of the political situation. Has to be seen. Problem with all this rising market is basically they are illiquid and very difficult to access. Last but not least, not my opinion, but I heard it 2-3 times over the last weeks. Africa is again on the radar screen like it was 25 years ago. It can be. I would not bet on it, but it's a fact that there is a lot of potential if one day they start really to invest. These are some areas.
Well, there is a particular question about Russia. Anton is asking, one of your slides showed that Russia would not be a significant contributor to the next decade growth. But what do you think could change that? For example, could the higher tolerance to debt, GDP, and the resulting investments in infrastructure could be a game changer for Russia?
Well, first of all, here you see that Russia is expected to grow 3% over the next 10 years. Over the last 10 years, you can see it was growing at around at 1%. Jim O'Neill, who presented that chart, said one of the key drivers for growth is the population. And I'm trying to find Russia on this one, so I am sorry for my ignorance. This won't be from, no, actually it's here, 145 million inhabitants, roughly. So you have, for a start, definitely some ingredients for growth. The problem basically is you need to let all these brilliant people I've met in Russia to let emerge into economies, into companies, and that they prosper. It is obviously from the outside tricky, but less bureaucracy would be extremely helpful. And last but not least, a shift away from commodities, in particular oil, could be helpful. But with 3% growth and with Schiller PEs of around 5 to 6, Russia is for me definitely an area you can consider. But the question is, will there be reforms over the next 15 years? You are in a better position to answer that than me. On one hand, I strongly assume that your president wants to prosper. If he will do everything needed, the future will tell.
Mm-hmm. Well, coming back to the industries, Serjan is asking, could you give some hints on profiting from the emerging opportunity of 5G tech? Apart from just digital IT stocks in other industries.
Yeah, I mean, all production companies which can be automated, which need the Internet for Things, will profit. The question is, will this be the traditional ones? I mean, I've seen the newest Mercedes factory. There are no people there. It's all computerized. Obviously, this only works if the internet is so fast that there is no error, or at least the error rate is on a level which is extremely low. All things like automated vehicles will profit, but will it be Tesla? Will it be somebody else? The answer is open. So far, obviously, Tesla is by far the leader, still loss-making. So you have, if you are not investing into the providers, into people who sell the data, for instance, telecom companies, you need to find producers where this technology is applied and where people are put on the road and replaced by computers and machines.
Right. Well, there is a practical question on portfolio building. Carl is asking, MSCI Emerging Markets Index, since end of 2018, have been gradually adding China's A-share market, mainland China, into the basket. And now China constitutes more than 20% of the whole. So usually in practice, how to mitigate possible bias brought by such big change, because index is not consistent because of that.
Well, first of all, the inclusion of A-share in China was announced and known. This happened over the last months, and if I'm not completely mistaken, it will continue over the next years. So there will be a natural flow into China A-share. China is similar to Brazil, is similar to Russia, and also to India. Then we are back to the BRICS. You never know how the political situation is going to change over the coming months, years. But on average, with a lot of volatility, the likelihood that at least China goes further up is high. The key question is also, do you want to play this area with indices, ETFs, pick themselves, be global? I think be global in an ETF is not a good strategy. Pick it yourself, can work, but you are then just index. In this area, there are a lot of interesting active managers around the globe which have beaten and probably will beat their relative benchmarks. So I would delegate that to active managers, but, and now it comes the big but, I would definitely, if I have 1 million, I would at least choose 3 to 5 managers to spread it for one idea. And if I have less, obviously the amount gets less, but you cannot know in advance which one will definitely profit. Or I give you an example, there are 4 hydrogen leaders. Two of them have decreased over the last 4 weeks significantly, and the one with the least positive outlook has gained. The person who told me this story said, "Look, I'm like a gardener. I put seeds around, I spread it around. I don't know which one of the four or if all of them will be the winner, but I spread it in a way that they are equal weighted, and then I wait and see, and as soon as I see which one is getting better or worse, I rebalance, and I might add to the winner more, and I might even sell the loser." But diversification, although a very old concept in such a thing, is quite important, because you really honestly cannot know. I strongly believe that Asia will continue to go up, but I also know that Asia can lose 50% within 3 months if something happens.
Mm-hmm. Well, now going a bit up to the macro level. Well, some economies expect possible new waves of COVID in the future. This possibility still exists. So probably it's time to draw a conclusion whether it was a good strategy for some countries like Sweden or Belarus not to introduce quarantine measures during the COVID. What can we say about the depth of the GDP fall and the consequences? Was it a good strategy or a bad strategy?
I mean, for Belarus, you excuse me, this is out of my competence. For Sweden, nevertheless, I have seen some comparable statistics, be it on the not the lockdown, be it on the effect on GDP, be it on the effect of infected people and recovery ratio. In Sweden, the GDP shrinkage was similar to countries with lockdown, although they had no lockdown. The herd immunity seems not to work because there were cases where somebody was infected and got reinfected, although one hoped that he or she will be immune. The only country which has more than 50% of people already infected once with COVID is India. They have obviously also no measurements. The Indian stock market is down. The GDP is substantially down. So there, I would say it hasn't worked, but maybe for other reasons. Another extreme example is the US. I mean, they had partially locked down, but they didn't really have measures. But if you look at the stock market, if you look at GDP, due to stimulus, due to the resilience of the American society, it really worked. Or it really worked better than in Europe, let's put it that way. The key question forward looking, because this is all history, is will there be a vaccine and how will it work? And I read yesterday a piece that some of these tested vaccines, you put it once and it will help you for 1 year or max 3 years. Question mark. Well, first you would have to repeat it in future. If, and now it comes the if, which I cannot answer because I'm more an economist than somebody who knows about this pandemic. Can we extinct it? Question mark. Like other things we used to have in the past and there were vaccines. The honest answer is nobody can really for sure tell you that. What is for sure, for instance, Zurich, according to statistics, we are in a risiko area now. If I walk here out of the road, I mean, I see people with masks. I see maybe less people in restaurants, but people are working. Everybody is in school. There are quarantines. There are new cases, but we will have to learn to live with this new normal. And some industry are up to 100%, and some, like for instance, tourism, is not going up. But even tourism is not straightforward. I mean, places like Zurich, as an example, so cities or London, they have almost no tourists. But if you go in the mountain in Switzerland, as an example, they had a very good summer. It's open what will happen in winter, how the measurements will be, how can you be on the ski slopes, in the elevator, with mask, without mask. This is completely open. But in other areas, for instance, construction has never really stopped. These are all open questions, but I would strongly argue that the forecasts are still too bleak to what will happen, not knowing what definitely will happen, but more coming from the angle of where the forecasters are.
Right. Thank you very much, Andreas. So there are, as usually, several questions about major commodities that are most interesting for these markets. But you have well anticipated these questions, so they made a good outlook for oil and for gold, as you see this. So basically, thank you for meeting all these questions. I would just remind all our viewers that we have had another meeting with our prominent speaker, with portfolio manager, CIO of Blackfort Capital, Andreas Bickel, with his macroeconomic update. And as usually, we are open, the video studio of CFA Association Russia is open for members and eventually non-members who can contribute their expertise to the financial community. Please send us your ideas, and also remind our audience that the recording of this meeting, as well as of other meetings, will be available to all members of CFA Association Russia and to the subscribers. And I hope soon we meet again with Andreas. Thank you very much, Andreas.
Thanks a lot for having me.